Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking retail and retail real estate. Please welcome my next guest, Stephen Marks. Stephen Marks is Managing Director with Fitch Ratings. He's joining us on the phone today. Stephen, thanks for being with us.
Michael, thank you very much for having me.
Well, Stephen, I know you watch the REITs very carefully, and REITs are kind of interesting for people watching the show because in the public REITs, you have some liquidity. You go in and out of these REITs. So how did retail REITs perform last year?
Well, for the first 9 months of this year, in general, the retail REITs did pretty well, pretty much in line with our expectations, and it is important to break it down by asset class because there are so many retail formats. So probably sort of biggest to the smallest, the mall REITs, and even those you have to bifurcate between the kind of the Class A and the Class Bs. But in general, the mall REITs did pretty well. On average, their same store NOI growth was in the low single digits. Occupancies dipped a little bit for some of the B malls, but we expect them to come back into 2017. When you get into the strips and the big boxes, again, kind of a similar story, low single digit growth. And then when you're talking about the freestanding triple net, pad type assets, those generally run at 1 to 2% growth, as most of those have embedded lease bumps. And so, in general, a pretty solid year for retail. I think the biggest surprise was that we didn't see that many tenant bankruptcies. Although, having said that, there's definitely perhaps some thunderclouds that we see in the future into 2017.
Right, and let's talk about that. Of course, we've all heard about some of the closures that some of these big boxes are having. So which types of REITs might that impact, and what do you expect?
Yeah, it's a good question because in general, it should impact the malls primarily because that's where the Sears, the JCPenney's, the Macy's, and even to a lesser extent, but still pretty important, are some of the major inline tenants. I mean, you read the headlines and you see what some of these companies are doing. Gap closing a lot of stores, Aeropostale, their issues. The Limited just did a straight liquidation. They announced a straight liquidation a couple of weeks ago, as opposed to some sort of reorganization. And so within the mall space, we see that the A malls that are well located, have good sales per square foot generally, should be fine because ultimately location trumps anything else when you're talking about real estate. We think that the B malls, where perhaps sales per square foot is not as productive, you're in perhaps secondary or tertiary markets, it's incrementally harder to find that next tenant willing to enter the space, particularly if it's a big anchor. So we think that while there are a lot of cross currents with some of these tenant bankruptcies and tenants exiting their spaces, it's going to impact the B malls primarily in our view.
Okay, we're talking with Stephen Marks. He's Managing Director with Fitch Ratings about retail and retail real estate and REITs. So, Stephen, what are some other factors that could impact retail and retail REITs moving forward?
Certainly, it's and really just touching upon the topic we were just mentioning, the tenant bankruptcies and the pressures a lot of these companies are facing. Ultimately, in many ways, is driven by competition and specifically e-commerce. And the e-commerce growth is not slowing down by any stretch. On the margin, it does impact the B mall properties disproportionate to the A mall properties, and so we see that the e-commerce trend always going to be a negative factor impacting the bricks and mortar real estate space. That's going to result in tenant bankruptcies or tenants looking to reduce their rents or really any type of distress that we've been seeing really across the spectrum. For that are things that the e-commerce trend is going to impact, and right now is right around the time where you begin to see it, because here we are in January, the holiday season's over, tenants either made it or they didn't, and the Limited is a good example of a tenant that just didn't quite make it, couldn't quite adapt to survive in this new environment, and so e-commerce is probably the biggest risk. The second thing, and it's more of a secondary concept, but it's something that we do track pretty closely, is looking at what is the depth of financeability, and in particular in the CMBS space, and then ultimately in the straight insurance company mortgage market for the financeability of some of these assets. And if it's an A mall, well located, strong tenants, strong rent per square foot, that asset can be financed fairly consistently in the mortgage market. What we're seeing in the BMOS space, though, is that it's much more difficult if sales per square foot are below, say, $350 or $400 a square foot. The insurance companies, those lenders, are going to either not touch it or will price a mortgage accordingly to account for the risk. And so when we think about credit for REITs, we're focused on contingent liquidity, i.e., can you get a mortgage on an asset? Can you use that capital to deploy in other parts of your business? And for A malls, they've got it. For B malls, it's really an open item, and it's something that's going to evolve, and it's something that we are watching closely. Not just row 17, but for the next few years as well.
Yeah, that's a very good point, and we're already seeing it in some of the properties that we're selling here in the Southeast. So, Stephen, what about the impact of potential reduced corporate tax rates and personal tax rates? Might there be more job growth, more consumers spending money, and therefore an impact on retail and some of the retail REITs?
It's a good question. I mean, certainly to the extent that the consumer has more to spend, they are likely to save some of it and spend some of it. And so reductions in individual tax rates probably will result in increased consumer spending. Changes in the corporate tax rate, that's a little bit of an unknown in terms of how that may trickle down ultimately to the consumer. But perhaps as a tangent to that, because I'm a REIT guy, and REITs do have a certain tax advantage in that they don't have to pay corporate taxes. To the extent that the overall corporate tax rate does go down, it does take away a little bit of the tax advantaged elements of REITs, particularly if you're an investor, and overall corporate tax rates are going down. Well, now you're comparing a REIT that pays zero corporate tax to perhaps a corporate that's paying a much lower tax rate, and does that then make the REIT wrapper or the REIT structure a little bit less appealing to you as an individual investor when you're looking at the space? Something that we're monitoring, and we'll see how it plays out.
Yeah, that's interesting. Was there anything else about a new Trump presidency that might impact retail real estate?
Probably not in the near term. I think there are still so many uncertainties around ultimately what he is proposing, and then finally what ultimately gets implemented, and then how the market generally reacts to it. That it's challenging to really predict how his policies may go into effect.
Mm-hmm.
Other than the aforementioned individual tax rates, I think that one of all of them will probably have, if it does get implemented, probably have the strongest positive effect on retail demand.
Any closing tips for our listeners and viewers related to retail or retail REITs?
It's a tricky world out there. Because of e-commerce, it's creating this almost exogenous effect of something that you really probably couldn't predict 10 or 15 years ago, but now here it is, and much like as we as humans or as creatures roaming the earth, those who can adapt will survive, and those who cannot won't. And so it's interesting to see how the tenants are adapting with omni-channel strategies, with in many ways they like the fact that perhaps the consumer doesn't like a given product. They will return that product in a physical store, and that actually creates a multiplier effect on sales. If someone actually comes in and returns something in a store, they actually leave the store having bought more than what they came in with.
Right.
So things like omni-channel and how companies are integrating their online and retail strategies, those who are on the cutting edge of that are going to win, and those ultimately who have a defensible moat and a defensible strategy around how they can kind of defend themselves against e-commerce will adapt, and those who can't won't.
Good point. Got to pay attention to these tenants and how they operate. Stephen Marks, thanks for joining us today.
Thank you very much, Michael.
Well, stay tuned. We'll have more on retail and retail real estate right after this short break. Stay with us. I'm Michael Bull. This is the Commercial Real Estate Show. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out CREshow.com.